Have you ever wondered how prices are set in a free market? You know, that magical number that dictates whether or not we can afford to buy something. This is basically an economic rule that says that the higher the demand for a product, the higher the price will be, and vice versa. One of the most obvious factors is the cost of production. There is also the concept of marginal cost, which is the cost of producing one additional unit of a product. For example, if it costs $10 to produce 10 widgets, then the marginal cost of producing one widget is $1. And supply. Let's put it all together and see how prices are actually set in a free market. Let's start by looking at a simple example. Let's say there's a market for widgets and the demand for widgets is perfectly elastic. This means that the quantity demanded of widgets will double if the price falls by even 1%. I hope you enjoyed this video and learned something new. If you did, please leave a like and subscribe for more content. Also, feel free to leave your suggestions for topics that I should cover in future videos. And as always, thanks for watching and have a great day. In this case, the price of widgets will probably end up being pretty low because people are very sensitive to price changes. Now, let's say the demand for widgets is perfectly inelastic. This means that no matter how much the price of widgets changes, people will still buy the same amount of widgets. In this case, the price of widgets will probably end up being pretty high because people are not sensitive to price changes. Marginal cost is important because it helps businesses decide how much of a product they should produce. Let's say there's a market for haircuts, and the demand for haircuts is relatively elastic. Prices will be higher when demand is higher and prices will be lower when demand is lower. As the economy changes and people's preferences change, the interaction of supply and demand also changes, which affects the prices of products. This is why it's so important to understand the basics of supply and demand. If you understand how supply and demand work, then you'll be able to predict how prices will change in the future, and that can help you make smart decisions as a consumer and as a business owner. Of course, there are other factors that can affect the price of a product, such as the cost of production and the prices of related goods. But ultimately, it's the interaction of supply and demand that determines the price of a product in a free market. This means that if the price of a haircut goes up, people will probably cut back on how often they get haircuts. In this case, the price of haircuts will probably be relatively low because people are sensitive to price changes. However, let's say the demand for haircuts is relatively inelastic. This means that even if the price of a haircut goes up, people will still get haircuts because they need to look presentable for work or other social situations. In this case, the price of haircuts will probably be relatively high because people are not very sensitive to price changes. If the marginal cost of producing one more widget is less than the price that they can sell it for, then it makes sense to produce and sell that widget. But if the marginal cost of producing one more widget is greater than the price that they can sell it for, then it doesn't make sense to produce the widget. This includes the cost of raw materials, labor, and overhead. We already talked about how demand is affected by the price of a product. The higher the price, the lower the demand, and vice versa. But demand is also affected by a bunch of other factors too. For example, if the price of a substitute good goes down, then the demand for the original product will also go down. A substitute good is a good that can be used in place of another good, like butter and margarine. If the price of margarine goes down, then people will probably buy less butter because margarine is a cheaper substitute. Demand is also affected by the prices of complementary goods. A complementary good is a good that is used together with another good, like peanut butter and jelly. If the price of peanut butter goes up, then the demand for jelly will probably go down because people aren't going to be buying as much peanut butter, so they don't need as much jelly to go with it. Demand is also affected by consumer income. If people have more money, then they'll probably demand more of everything. That's why demand for luxury goods often goes up during recessions, when people have more money. And finally, demand is also affected by population size. The bigger the population, the more demand there will be for most products. That's why many businesses try to target their products towards a large audience. The more people they can get exposed to their product, the more sales they'll probably make. For example, if the price of oil goes up, then the cost of production for many products also goes up. This is because oil is used to make a lot of different products, so the price of oil affects the price of those products. Same thing with labor. If wages go up, then the cost of production for products that require a lot of labor also goes up. This is why the price of a haircut goes up when the minimum wage goes up. And while this might seem like common sense, there's a lot more nuance to it than that. For example, there's also the concept of elasticity, which is how sensitive the quantity demanded of a product is to its price. The more elastic the demand, the more the price will have to change in order to affect the quantity demanded. For example, if the price of a Big Mac increased from $1 to $2, that would probably cause a decrease in demand. But if the price of a luxury car increased from $100,000 to $120,000, it probably wouldn't have much of an effect on demand. That's because people who are interested in buying luxury cars are probably not very sensitive to price changes. They're willing to pay a premium for status and exclusivity, so they won't be deterred by a small price increase. On the other hand, people who are considering buying a Big Mac are much more sensitive to price changes. If the price goes up by $1, they'll probably just decide to make their own lunch instead. That's why it's much easier for McDonald's to raise the price of a Big Mac than it is for a luxury car company to raise the price of their cars. It is actually quite interesting how prices are determined by markets, because it's not just some random number that people pull out of thin air. In fact, it's actually pretty scientific. So today, let's talk about what determines the price of things in a free market. Prices are determined by the forces of supply and demand. Okay, so now that we've covered the basics, let's talk about some of the factors that can influence the price of a product. But the cost of production isn't the only thing that affects the price of a product. Now let's talk about the other side of the equation, demand. Okay, so now that we've covered all of the factors that affect demand, now let's look at a real-world example. As you can see, the price of a product is determined by the interaction of supply and demand, and that's why prices are always changing. But anyway, that's all I have for you for today.